perspective, what are the shifts which at least I see happening over time, and many of you would relate to it, nothing new there. But it's important to set the context in the, by way of observations on how things are changing in the recent times. And then second piece would be obviously the need for capital. And then what are the new, relatively new instruments and opportunities that some of those structures and instruments are relatively less used. So how those structures which SEBI has brought about could be used. And finally, what are the key elements for this entire ecosystem which can finance, which can actually enhance financing opportunities through securities market. So that is broadly the thrust of my presentation. So let's move on. So let's understand the shifts. So first shift is, and this is a long-term shift which we are observing, and the trends are very, very interesting. I think I'll not bother you with reading this chart. Let me straight away come to the key takeaways. This chart actually comes from the NSE data, and it tracks how the ownership of listed companies by promoters, by banks and financial institutions and insurance companies, as well as domestic mutual funds and FPIs has changed over time. So some of the key takeaways are, there is a decline in the shareholding of promoters if you take a long-term horizon. If you go back to the global financial crisis time, that time promoters were actually strengthening their positions in the companies, and that time the percentage of their holding was 57, 58 odd percent, which has now come to 50% by September 2025. 50% is obviously an important threshold. Promoters would, for the purpose of control, they would like to maintain that. FPI ownership is again showing an interesting trend over the last 15 years. It has come down to just short of 17%, and it used to be 22% at one point of time. This is again a 15-year low. Retail revolution, I'm sure all of you are aware how retail participation has increased in our market, both directly and indirectly through mutual funds. The mutual funds share has more than doubled in 10 years to a record 10.9%. And one reason is strong SIPs. In fact, about roughly $3 billion comes through SIP every month, as per the latest data which I saw. Individuals directly and through mutual funds, they are now holding 18.75% of the market, which again is the highest share in the last 22 years. So very clearly, retail participation is increasing, and it has certain implications for the market, for the regulators. Especially, for the first time investors who are coming to the market, they are reposing their trust and faith in the companies they are investing in, or in the mutual fund schemes they are investing in. So it's very important that that trust, that faith in the markets of retail investors is properly maintained. That is why corporate governance becomes more important. It's always been important, but it's more important now than ever. Investor education is, again, we want investors to come with the right knowledge to the market. They should be aware of what is good for them, what is not good for them, what are the risks, and so on. So investor education, again, has been an important area where we focus, but now even more important as more and more people, especially from the smaller towns, are coming to the market. And of course, you need guardrails to protect the interest of investors. So this shift has these three implications for us as a regulator. Let's move to the other shift. Again, nothing new here, but we've been talking about shift from shareholders to stakeholders, from profit to profit plus purpose. And you have evidence which kind of supports this. SEBI itself has DRSR which is mandatory disclosures on the sustainability side, including climate for top 1,000 listed companies. What will evolve is we want these disclosures to be reliable. We don't have a assurance ecosystem, assurance standards, ethical standards. These are going to evolve as I speak. Work is already going on by the relevant stakeholders. ISSB, those global standards on sustainability, they will further evolve. And ESG rating and associated regulatory frameworks will also evolve as we go along this shift which is happening. Regulatory concerns will be greenwashing and purpose washing. If you are claiming to be a ESG friendly company, or if you're claiming to be a sustainable company, are you true to your label? If you are claiming to serve the interest of a broader range of stakeholders rather than just shareholders, are you true to your purpose, or are you just doing purpose washing? So those are the concerns which will evolve as we go along. Let's move. Capital shifts. So capital also, conventionally we are very familiar with financial capital. But if you look at the literature, there is a discussion on social capital, there's a discussion on climate capital, sustainability capital, and so on. But to my mind, what stands out is the intellectual capital or the manpower that you have. And if today finance is not a constraint as long as you have a great idea, if you look at the US example, the Magnificent Seven, which drive the US market all the time, they are actually, and they account for the largest, taken together, they account for a substantial share in the market cap of all the companies listed there. They are rooted, if you just dig little deeper into what they do, they started with a purpose, not with a profit motive. They started with a problem to solve for the society, and they become so big. So we are seeing that evidence, in terms of the growth of the companies in sectors such as healthcare, fintech, again, where intellectual capital is more important than the financial capital. The evolution of startup ecosystem in India is again another evidence supporting that. And again, we are seeing the call for and also actual investments rising in AI, in data centers, and so on. So this is the global as well as trend here as well, which will catch up. So this is another important shift. This is, of course, this is, I think in every seminar, every symposium, AI has to be talked about. It's become so fashionable. What is interesting is AI was around, but the acceleration of AI has made news lately. And from a very narrow perspective, from a regulatory perspective, our view is that we should definitely, our market players, including issuers, investors, and intermediaries, they should benefit from the promises of AI. There is a need to ensure, and that is the part of the guardrails around it, you need to ensure truthful disclosures of prospects and risks and avoid false claims. You should not be making false claims, saying that the company is using AI and it promises fantastic returns because of using AI. So that sort of, the truthfulness and disclosure has to be maintained. And laws will evolve. We already have an AI Act in Europe. Regulatory concern again would be AI washing, as I mentioned, risk of bias, data privacy, and accountability issues. Again, this is another very important shift happening abroad, happening in developed world, not so much here, and we are thankful for that. There's a very clear shift from public markets to private markets, but India is showing healthy growth in both public and the private side. Both segments are regulated, as you know, but there is an alarming trend in stock markets abroad where the number of listed companies are going down. And the reason is simple. What is worrying in the West now, in US, somebody I was talking to, and they said, now we are getting liquidity, even in the private market. Earlier, the driver was to come to public market to discover liquidity, not so much to raise money. But if I'm getting liquidity also there, why should I come and list? So I think the incentives to list have to be maintained, but this is an area for us to keep an eye on. As I said, we are in a very good space today, and hopefully this space continues. And also another important point is we need to build pathways from the private markets to public. What do I mean by that? So and luckily, again, in our markets, there has been a healthy flow from private to public, but we should see how we can enable that movement. How can we make it more smooth so that this flow is not interrupted? And there could be regulatory interventions, there could be certain incentives, but that's a separate debate altogether. So on the shifts, this is the last piece. As you all know, this is again, in the world of regulation, world over, there is a demand for deregulation, and for good reasons. Of course, this varies from jurisdiction to jurisdiction. The main driver is, let's make things easier for business. Let's reduce the costs. Let's reduce the constraints which can affect businesses, and let them grow. Let regulation not be a hurdle for growth. That is the bottom line. We are for it. In fact, if you look at SEBI's agenda in the recent times, most of the agenda is focused on ease of doing business. Actually, when we go to the board, our board, we have to say it upfront. Is it ease of doing business or more regulation? So that sort of change has come over time. But my personal view is that is fine, but we should also be mindful of the risks and keep an eye on that. There has to be some minimum threshold. And also the trust, if we have more trust in the market players, this approach can work very well. But that trust should just not be an empty word. It should be backed by evidence, which should be demonstrated by the market players, which will encourage us to do more on the ease of doing business. So this was my first part of just setting the context, the way things are changing. Now let's look at the need for capital. Again, no-brainer is huge. There is some data from a World Bank report. So we are, as all of you would know, we are committed to achieving SDGs by 2030, and there's a huge gap in financing. So as per one estimate of a UN report, UNGC Network India report, 292 billion, this is per annum gap, and which is about 6.2% of GDP. And this is only just 5 SDGs, education, health, water, sanitation, power and roads, not all. The private flows are very less, as you can see, compared to the public sector flows, and increase in private financial assets, their flow can of course make a huge difference. Infrastructure financing, again a related area. So government spend has increased, more than doubled. This is again World Bank data, and I think it is based on a CII study. The gap exceeds 5% of GDP. And again, the study points out that the institutional investors like insurance and pension funds are heavily underinvested in the infrastructure side. So the risk capital for innovation, that is, which is, we need more and more capital for financing startups, for financing SMEs, and we need that capital to be patient. We need that capital to be able to take certain risks, and we need more investments in R&D. So again, capital markets can play a very key role here. This is an interesting snapshot of how market funding has evolved over last 5 years or so. So if you just look at the overall broader picture, 14.6 lakh crore was mobilized from all sources taken together, equity, debt, and REITs and InvITs, which is a 33% rise over the previous year. And the debt private side accounts for 68%, And as I said earlier, we have a healthy primary market, healthy IPO market. And we are in the top spot in the global IPO volumes. So this picture looks healthy. It's showing a rising trend. This way, much more can happen through these instruments. So today we have about 28 uh, InvITs and REITs taken together, which are listed, and 1.5 lakh crore has been mobilized in last 5 years, and combined AUM is around 9 lakh crores. So this area is attracting a lot of attention as far as we are concerned. So we are doing few things. One is we have enhanced our outreach. So we are meeting state government officials, we are visiting state capitals and telling them how they can monetize their assets through InvIT structure. We have also, we are looking wherever certain tweaks are required in the regulations to give it a thrust. We are doing that as well. So we did two steps recently. One was this: we classified REITs as equity. Hope is that this will probably bring more liquidity in the REITs market, in the secondary market. And we are also expanding the scope of strategic investors who can invest in these instruments pre-IPO. Another related area is municipal bonds. Again, we are giving a lot of emphasis on this. We are meeting municipalities. Again, we are visiting state governments, doing outreach, educating them about how this muni bond can be used. And it is not just a question of money, it is much more deeper than that. Idea is if a municipal body raises money through municipal bond, it will undertake to get into certain financial discipline in terms of reporting its financials on time, in terms of professionalizing its activities, in terms of improving its governance. So there are a whole lot of benefit which we are trying to tell municipal bonds to come to the market and raise money. And as many of you would know, this is a big market in US, and we are nowhere when we compare with, I think there it is, the municipal bond outstanding is in the range of 13-14% of the GDP. So it's really huge. And again, of course, there the lot of tax incentives for investing in these securities. Some of the recent steps, again, NSC has launched a municipal bond portal, and we have an e-learning course on municipal. This we developed in collaboration with World Bank, and we are seeing traction. In fact, numbers look less, but we are seeing traction, and we'll like this market to grow. ESG, again, we have a wide bouquet of frameworks which are available. I'll not spend much time on this. In this space, our issue is, for example, green bond framework has existed since 2017, but just about $1 billion has been raised since then, over the last 8 years. We would like this segment to grow. So what our understanding from the market is that there is a green premium which is missing, and greenemium, we would like to explore how we can help in creation of that, but that is a function of demand and supply market forces. We are open to suggestions on improving this market. Let me move to another new product which we launched in recent times, and we're already seeing some good traction here. I think 4 SIFs have been already launched. So this is a product which falls between mutual funds and PMS. The idea here was that many retail investors who were going to unregistered investment advisors or YouTubers who were promising them fantastic returns which was not realistic. So can we cater to the needs of those retail investors who are willing to take little more risk, and they can come to this SIF structure where the minimum threshold is 10 lakhs of investments. So this, I believe this will grow further. Another very interesting innovation, I would say, in the last few years that we've done is the creation of social stock exchange. Again, this needs more attention, more traction. But let me very briefly tell you the concept. Some of you may not be that familiar. Idea is, can we leverage our securities market infrastructure for the benefit of non-profits? Can the non-profits come to the market? So in the process, they become more transparent and they are open to a wider pool of capital. Today, typical NPO financing is one-to-one. NPO, I look for a donor, it is a one-on-one arrangement. Here, we are changing it from one to many. You are an NPO, you go to the market, many people can actually support your cause. And it is the three pillars: trust, transparency, and accountability. Basically, it brings together the investors who have faith in the purpose for which the social enterprise or the non-profit organization, it could also be a for-profit organization, is committed to. Can they come together? Can this market bring them together? And ultimately, it is not so much the exchange, it is the communities which are at the heart of this concept. What does the community need? And how does the community's needs are translated into the goals of social enterprises? Social enterprises look for financial investors who are committed to those goals, and then they come together through the exchange. And in terms of, let me just pick one element, transparency. When you ask for funds, you have to be transparent. What do you need it for? When you use those funds, you have to be transparent. You have to disclose where you've used your money, just like any listed company will do. And then you have to disclose your results, which are auditable, and based on that, if you do well on this front, you can again come back to the market and raise further funds. And then you create social impact in the process. This, I think, is a very powerful concept. We put all elements together, but we need to see more traction here. I'm mindful of time. There are some other instruments, going back to my earlier slide on purpose with profit. So we have enabled zero coupon, zero principal instruments, which can be used on the social stock exchange platform, where there is no financial return, but there is the promise of a social return which compensates for the absence of financial return. So if you are really committed to a cause and you see great social return value, you could subscribe to this instrument. Development impact bonds, again, a very powerful concept. There is a link, but I'm mindful of time. So very, very briefly, if I can explain, the development impact bond is you pay for success. So there is an outcome funder. Just one second. I think it's difficult to explain without the visual here. So there is an outcome. This is from a real life example of Educate Girl Child project in Rajasthan. So where the outcome pair, basically they hold back the money. They look for a risk investor. Risk investor comes, risk investor spends the money through a service provider. Whatever the outcome is achieved, that is evaluated. And if the outcome funder is satisfied with the outcome after the third-party evaluation, then outcome funder will release the money to the risk investor. Risk investor has a markup, but it is loosely called pay for success. This could be used by government departments. This could be used by CSR funds of the companies. This could be used by anybody who wants to spend on social causes, but he just wants to he doesn't have the bandwidth to do it. He is looking for relevant parties to come and do this. There were fantastic results in Rajasthan, but I think we don't have time to go through those details. So let me just come back. So here we are. Yeah. So social impact funds, very, very quickly, this is a kind of AIF, which is already there in our framework, but again, not used much. Here the idea is you could have a social impact fund where you could have 100% grants in and 100% grants out. So earlier we had a combination of the two. You are not under pressure to generate financial returns. So these are some of the underutilized regulatory frameworks. Innovators Growth Platform, this we had come out with several years ago in collaboration with the startup sector in Bangalore. Idea was, can we create a platform where startups can come and raise money? But again, we've not seen any traction for various reasons. Maybe it's easy to get money from private equity rather than come to exchange for raising money through this platform. Then we also have a framework of DVRs, differential voting right. By the way, the US government, one reason why NASDAQ market grew so much vis-a-vis London Stock Exchange. London Stock Exchange did not have differential voting rights, whereas NASDAQ had differential voting rights. So we'd also created this, but there have not been many takers for this. Some of the products which I already talked about, green bonds, micro SIPs is a relatively new phenomena. Hopefully this will catch traction as we go forward. Again, here the idea is, can we make investments in the mutual fund segments more inclusive through this product, where the SIP is very, very micro and very easy KYC and so on. The small and medium REITs, social impact funds, ZCZP, I already mentioned about this. There's a need for more traction. Let me conclude very quickly with the last slide. So what are the key elements, which can facilitate all of this? So just broad brush I will do, not spend much time. You need innovative instruments, and we are very much for it. We would welcome, any new instrument which the market wants, which the market sees the need for. Happy to work with the market players and develop more instruments. But we would like also, once you create an instrument and you don't see any traction, you would like to see that to grow. So that is one. We need robust markets where there is good liquidity, where there is, good number of players, and we have robust markets, but we have to maintain those elements of the market. Investor trust, I think, is very, very crucial. As I said, especially with the influx, if I can say, with the rapid increase in numbers of retail investors, their trust has to be maintained, and I think that should be a non-negotiable. We have to have enabling regulatory infrastructure. As I said, we have a very open door policy in terms of receiving new ideas, in terms of giving reactions to our existing policies, and so on. And we are open to creating whatever is required for us to take the market to the next level. Of course, the systemic risk is very important. We have to keep an eye on that as well. We can't afford a systemic crisis, which can become, very long, and it can have its own consequences. But that is our regulatory job, together with other regulators, to keep an eye on any systemic issues which are lurking in the market. And as I said, all of you from the market side, you are very important partners in what we do. So that's the reason I just want to conclude with this line: let's co-create the future. Thank you for your attention.
Thank you, Amarjeet Bhai, for those words of enlightenment. And we as market participants would like to follow on the same. So moving on to our panel, may I request our panelists Anand Rathi ji, Revati Kasturi, Pratik Shah, and Ganeshan to join on the stage. Till such time we set the stage, Amarjeet Bhai has agreed to take some questions from the audience. So if there is any question, please feel free to ask. Can a mic go there?
Yes,
Please
sir.
go ahead.
My name is Vishal Sanghvi. I am Innovation and Business Accelerator. I was recently part of the Surat Municipality Green Bond, event at NSC, and I come to know about such kind of initiative where, fund can be generated for any, green kind of environment actually. So I see that there is a lack of, professionals in a startup economy, scale-up startup economy who has something initiative new. So how, and when I talk to the company actually who has, raised this entire this process actually. So I see that there are a lot of smart city initiatives government has taken, but there is a lack of how this reach out fastly. And I notice when I talk to many chartered accountant, whether you have such kind of knowledge, so there are many people doesn't have such kind of knowledge actually. So I see this how we can fill the gap of this professional to current ecosystem. So because the variety of finance available, our growth of which is the tagline of our this initiatives. So this I want to know.
I think what you say is absolutely right. So there is a need to create more awareness. And we are trying to do that in our own limited manner. We are doing, in fact, I was in Raipur just 2 weeks back. So we had a meeting with the Raipur state government officials and some 4 or 5 municipalities of Chhattisgarh, they also came. And one day, I'm just giving you this example, how we can nudge the things. So one day we did elaborate presentations. We also had merchant bankers, legal advisors, we call everybody. And people came and talked about various dimensions. So very next day when we had a meeting with just the state officials, they were asking very relevant questions. How can I improve my credit rating? And I could see the change in one day we brought about. So it's a big task, but let me tell you, things are really changing. Things are changing fast. In the states, we did one event in Madhya Pradesh. Again, similar experience. There is an appetite to learn. There is an appetite to make a difference. So which is very positive. At least personally, I see that. I would suggest that, if the other stakeholders, they can also, see, we have limitations. How many such programs can we do? How many people we can reach? We are such a big country. So we would like our messengers, who can do this and take this word. Even, for example, this whole asset monetization promise that you have in state governments, there is a need to create more awareness around those products. And we did that in UP recently. We went there and we had a 2-hour meeting with the state administration. Top officials were there. A lot of questions, how we can do this, you guide us. So we can go only up to a point, but I think if we work collectively together, I think we can make a difference. So I agree with you. This is not just financing, this is also challenging the whole ecosystem, bringing in more professionalization in the entities which adopt the market-based instruments. So it is very promising, but we have some way to go.
We'll take one last question.
My name is Vineet Nahata. I happen to be from Powergill Treasuries. So referring to your presentation, you had brought to the limelight two issues. One was greenwashing and purpose washing. And the second was lack of greenium as far as the green bonds and climate change bonds, etc., are concerned in the Indian market. You have been correct in stating that, sir, even the sovereign green bonds issued by RBI, they are selling at a discount to the normal green bonds. So some of the reasons why there is a lack of popularity, lack of awareness, and lack of interest in the green bonds happen to be a lack of tax incentive. The post-tax yield is much lower in the green bonds, which doesn't excite the investors to put in money. Second is the absence of clawback clauses. In case the purpose is not met, then what is the exit route, or can the coupon be enhanced to the normal market yield? And yesterday we had a session on the green financing only. Over there, it was said that allocation in priority sector lending of green bonds has been presently not being considered because of the crowding out effect. So, in my opinion, so there is one area where the access of green bonds from a larger pool of investment can be made is, we have a lot of funds to be invested by the pension funds, EPFO, ESIC, NPS. They have a set investment pattern. Now, in case a compulsory allocation of 5 to 10% can be made for the green sector, this could be a good way to generate access to funds for the green issue. Thank you.
So thank you for that. I think those are good suggestions. What we would like to do is we would like to look at incentives more than the disincentives, because that is what we need at this point of time. Let the market grow, and then we can look at how to sort of put more guardrails around it. Your point on the coupon or the yield, I think if the greenium is created, that problem can be taken care to some extent. But in terms of, the clawbacks, I would hesitate to go that path today. Because as it is, I'm not getting issuers. So if I put more riders, it will become more difficult. So, and other suggestion on creating incentives or creating some quotas, etc. These are good ideas, but I think all the stakeholders have to pitch in to make it work. But thank you for those suggestions.
Thank you, Amarjeet Bhai. And in absence of time, we'll go to the panel discussion. Our panel is about building deeper capital markets, debt, equity, and commodity derivatives asset classes. And I'm joined with distinguished panel. To my right is Anand Rathi ji, founder and group chairman of Anand Rathi Group. To his right, we have Mr. Ganeshan. He is managing director and head of corporate coverage and advisory at BNP Paribas. To my left is Revati Kasture, CEO, Carriage Global IFSC Limited. And we have Mr. Prateek Shah, who is partner at Ernst & Young. If we look at infrastructure financing, if we look at financing for investment growth, on one side we have a scenario where our honorable road minister is building roads at a frenetic pace and says, I'm not constrained for lack of money, I have more than enough money to build roads. And then in central Bombay, we start dismantling a bridge, and two arms of the government are unable to get 60 crore rupees to complete demolition of that bridge, and they are fighting. This is the contradiction of India. On one side, there is enough money available, on the other side, there's no enough money available. Many a times we believe markets are good level playing field. But today we have a scenario in market where one broker's market cap is more than entire exchange's market cap. Now whether exchange will go up or broker will go up, who knows? But in those contradictions, I have this panel to guide you over the next 45 minutes. Let me start with you, Anand Rathi ji. You have been doyen of Indian capital market. You have seen all the ups and downs. How can equity markets in India introduce better listing requirements so that SME exchange become as vibrant as PE and VC market? Also, what incentives we give for small and medium enterprises to eventually graduate to main board? And how do we ensure that there is good investor base, good governance, and most importantly, availability of capital to small and medium enterprises?
Thank you, Nilesh bhai. Thanks to CII for inviting me to this conference. First of all, let's congratulate Amarjeet Singh, very nice presentation that you made. I think SME exchange opening was a game changer. We have largest number of SMEs in India. They need finance. Obviously, when venture funds came, private equity, they started giving some. But obviously, the need is much, much more than what is even available today. So I think this is a great effort. Today, already more than, I think, 1,200 SME IPOs have come. The companies are working. I believe the returns are also, as the their index is showing both BSE and NSE.
It's the world's best performing index.
Exactly. More than 100% return. So I think, therefore, first of all, Nilesh bhai, I think it's an excellent thing. We need to promote more and more SMEs to come to this market. I think first and foremost is to make this popular amongst SMEs. That's where I think SEBI exchanges, even the investment bankers, they need to educate. I think what I found when many SMEs approached me, they were not even aware of how they can go about it. So first and foremost, I think we need to educate them more. In terms of incentives, I think how we can make it more less compliant, because SMEs are not used to, for example, very detailed compliance. The cost also, while on one hand we need transparency, we also want to see that good companies come. Few cases, wherever things have gone wrong, should not be used as a benchmark to judge the SMEs as such. I believe that my experience is most businessmen, most entrepreneurs in the country, they want to grow. And they want to grow in a very, very constructive manner, in a manner that they don't want to dupe investors. But, few cases, if something happens, that should not be taken as an indication. So I think what could be seen, one is whether we can reduce the compliance requirements. Also one, thing, even for large companies going, whether there is any need to show quarterly results, whether we should move to, with 6 monthly results because many times it puts pressure on entrepreneurs to show quarterly results. Now every business has a different cycle. So I think in terms of compliances, if we can help them, of course, another thing that for small these companies, SMEs companies, can they be specialized mutual funds created for these, where they invest only in this category? So that then there is option for even investors to, more liquidity can be created. So these are some things which I think will suggest. A lot of companies are already moving from SME to main board, which is again a good sign. I believe that almost 300 plus companies have moved. So I think this is a good platform. We need to expand it. We need to support it. In terms of tax incentives, I don't think, that can be thought of in terms of any tax incentives for this. But compliance, support from the mutual fund industry could be the good way to promote this.
So Amarjeet bhai, thoda mauke pe chauka ho raha hai. But if I have to invest in small and medium enterprises, I will need sell-side research. No mutual fund will have capacity to evaluate 1,000-odd companies. Right, sir?
Absolutely right.
So, you trapped me actually, but so this is a very interesting, very topical issue for those who do not know. We have a consultation paper out and we are in active discussion and debate with industry on what is to be done. So, see, we are, on a serious note, we are not against research. Definitely not. Which is good for the market, good for investors. We all acknowledge it. I think what we are rooting for is more transparency. See, as a regulator, we don't like hidden costs. We don't like opaqueness. We want more transparency. That's all. But, we are in discussion and we'll see where we land on this. But that is, just wanted to clarify, that is where we are coming from.
Thank you so much.
Take 1 minute on this, since you raised the topic. Sir, I think the understanding that there is a duplication of research by the buy side and sell side, that I think needs to be clarified. the sales side research, obviously there are much more detailed research which they provide. Buy side only evaluates them to decide. But this was not a subject, but since Nilesh bhai you mentioned, I thought I will mention this. Thank you.
इसको यहीं पे छोड़ देते हैं because you
Bilkul,
know
sir.
people are curious to know what others have to say. I've already
Absolutely.
spoken enough.
So now moving from SME to corporate and institutional, मतलब गणेशन भाई अभी तो हम लोग गाना गा रहे हैं, ओ जाने वाले हो सके तो लौट के आ जाना. You have seen FPI selling quite regularly. Now, from your point of view, from corporate clients and institutional investor perspective, how do you see the position of India as a key equity market or hub globally, and the evolution in the equity capital markets over the past decade? What steps can be taken to further develop this?
Yeah, thank you, Nilesh bhai, and thank you, CII, for inviting me to the panel. So, Nilesh bhai, you know, it's a very topical question because, you know, I would say we have never had a more exciting time in the Indian capital market. You know, if you really look at it, I think just to put it in context, 2024 calendar year, India had a primary capital market activity of over $70 billion. And that puts India as the #2 primary capital market for equity in the world after US. So, you know, we never had such a large focus, you know, on the primary issuance from India. So, you know, what has changed? I think first is the macro, because, you know, I really believe India is truly, you know, at a moment where we have the Goldilocks effect, as you call it. So, you know, obviously we have a very stable macro, which leads to, you know, low inflation, low interest rate, you know, that is really helping the economy. We have a very strong consumption. You know, obviously there is tariff and other issues, but the fact is, you know, the domestic consumption is so strong that, you know, that's really not impacting most of the large corporates who have large plans locally. And the third is the demographic dividend, which India is placed quite uniquely. So I think the fundamentals of the macro are very strong, and that is leading to, you know, obviously this kind of growth, both in earnings and hence the market cap. So the India's market cap today is about $5.3 trillion. And, you know, if you just look 4-5 years back, it was, you know, half of it. So, you know, we have doubled in terms of market cap. And, you know, this is obviously linked to the GDP growth. So as we grow the GDP to 5 trillion, you know, I'm confident that this market cap will also double. Now, coming to your specific question, yes, I think we have seen a fundamental shift in inflows. And I'm sure you're not complaining. You've been a large beneficiary of the growth in the SIPs and the mutual funds. So I would say there has been, you know, quite a fundamental shift. So if you go back to 2021, just to look at the funds flow to the equity market. So the funds flow used to be about 40 billion, of which 20 billion was foreign investors and 20 billion was domestic investors, and we were quite reliant as a market on foreign flows because that used to, you know, be a major component, if not, you know, at least equal component of the flows. And, you know, any month where there was a macro event which impacted the flow, the Indian capital market used to be impacted. So I think from that we have moved to a situation last year where the domestic flows was over $60 billion. And the foreign flow was almost close to, you know, zero. So on a net basis. So I think we have seen a growth. Obviously, the 40 billion has become 60 billion last year, and this year, year to date itself is about 60 billion kind of net. But I think the shift is, you know, obviously we've kind of, you know, more become domestic flows. I think that is good news because I think our you know, our Prime Minister talks about Atmanirbhar Bharat. I think we have truly become Atmanirbhar in the equity capital markets now. So I think, you know, that's extremely strong. And I think the reason why this is happening is one, India's, one of the most transparent market. I think if you look at various regulation and thanks to, obviously SEBI and, all the measures they have taken, I think it is like if you look at IPO, no other market in the world, you can see a live tracking of the demand, right? So the transparency initiative has really also given comfort to investors that everything that you need to know is in that domain, and I think that has played a big role in this in building this confidence. Now, coming from the floor to the other side, I think we have also seen an evolution in terms of the issuance, right? So I think earlier we just had equity and stocks. Now we have InvITs, we have REITs. So I think the number of products has increased, and I think as Mr. Amarjeet mentioned, I think there are more products, including for the social sector, which is obviously a great initiative. I think in terms of activity, what we have seen in the last 12-18 months has been more secondary kind of flows to the market. So it was either the private equity selling. It was a lot of multinationals are listing their Indian subsidiaries, which is also becoming a big trend. But a lot of this activity is secondary, which by itself is okay, because the private equity had invested in the story for the last 7-8 years, and now they have an exit. So I think the good news is now this exit will fuel more investments from the private equity going forward. We just saw a local private equity firm, Chris Capital, raised almost $2 billion in their latest fund. So I think just that the scale of activity is going up, and I think as the market grows, I think it's a good evolution we have. So I think all these factors put together is making the markets quite robust. And I think what we need is, as we see more large offerings, I mean, the number of $1 billion plus offerings are increasing. I think as we see more large offerings, I think there will be a shift to more institutional demand, and I think we need to just see how we can, I would say that obviously keep the domestic inflows high, but also see how we can attract more foreign flows in addition to that.
Thank you. Now moving to rating agency. Revati, globally rating agencies say we have poor standards, we are moody. In India, we say we care. Now, in that context, how do that private credit domain growing in India? And are there any key emerging risks and mitigants, if any? Amarjeet Bhai's presentation also showed that the debt market contributes significantly on resource mobilization. What are the trends changing over there? And the current, very recently, RBI liberalized some of the bank lending norms. How will it impact private market?
Thank you, Nilesh Bhai, for the question, and thank you, CII, for having me at this conference. Private credit is a very upcoming kind of area, and we all know that. It's grown significantly. It was about $0.7 billion 15 years back, and it's about $25 to $30 billion now. And if I just kind of place it in the entire lending ecosystem, then banks lending to large industries, NBFCs, is $3 trillion. So, still 1%. So it's still very small. And is there a room for growth? Definitely yes. Is there a need for private credit? Again, definitely yes, because private credit serves needs which are not exactly bankable concepts. They kind of come in where they sit between that space where there are structured transactions largely in infrastructure, and Amarjeet Singh's presentation also spoke about the need for infrastructure funding. And they sit in that infrastructure, real estate kind of a space, which is again a very key element for the economic growth. You asked me about what are the challenges or mitigants. In US, you saw very recently about 3 large funds going down, and that was largely financed through private credit. In India, if I kind of bifurcate the risk into two kinds, let's say systemic risk and performance risk. Now, in systemic risk, I think the regulators have done an excellent job. Because if you look at RBI, they've always discouraged interconnectedness between banking and non-banking ecosystem. When you discourage that and non-banking ecosystem, if it was lending to wholesale credit, that has come down significantly in the past 3, 4, 5 years. So that's one thing. Second is that if you look at Cat 2 AIFs, there's very limited room for borrowing in those Cat 2 AIFs, and that's again thanks to SEBI regulations. Most of the funds which failed abroad were also borrowing from the banking ecosystem. That's lending banks also exposed to this particular risk. So on the systemic risk, I think the regulators have taken care of. On the performance risk, as how do you evaluate the performance of these private credits? Like, let's say for mutual fund, you have a credit quality rating of mutual funds, which tells the investors transparently what is the expectation that they should have on this fund. You don't have anything similar for AIFs. So in that sense, how do you communicate very transparently to the investor the risk that is associated with this? And give them tools for decision making. So I think that's where we still have to work a little more. But I think on the whole, private credit is a space which has to grow, and it is something that is the need of the hour also.
Sure. Pratik bhai, I started my career as a bond fund manager, and today when I look at, we have done well in bond market. But every time I get invited to speak at some panel on debt market, it is always about how to deepen bond market. मतलब और कितना deepen करना चाहिए? You are expert from the outside. You can, comment whether we players have done a good job or a bad job.
Nilesh bhai, it's a tall order to speak about bond markets to you, but I'll still give it a shot. I think if you look at, Kasturi ma'am also mentioned, I think bank credit, if you take credit per se, bank credit still takes a primary share as far as the whole credit share is concerned. And as we go from 4 to 7 to 10 trillion, I think the whole credit space, apart from equity where a lot has been spoken, there is room for doing a lot more, if I may try to say that. Because if you look at our bond market, we are still 19% of the GDP compared to the US, which is about 119, 120% of the GDP. And especially if you take securitization, if you take the municipal bonds that Amarjeet Singh mentioned as well, there is still a lot that can be done in terms of deepening the bond market. And I look at it from both standpoints, from a demand standpoint as well as from a supply standpoint. And I put some thoughts together, maybe I can give them a go. I think the whole concept, at least on the demand side, the whole concept of pooled bonds or muni bonds, I think there is an opportunity where that itself is a 2 trillion opportunity for our municipalities and our local bodies to become a lot more disciplined and start using their revenue producing vehicles and issue bonds out of that. And goes back to the first point you mentioned, where there is a lot of money, but then there is no money for certain pieces. So is there an opportunity where we can drive this? It's a tall order, but is that something that we can continue to raise in these forums? I think there is a merit over there. I think even the bond market needs its UPI moment, where you have a single issuance and a documentation platform. So rather than having a long journey of issuing bonds, how do you get depositories, rating agencies, everyone on the same platform and make it a lot faster process from a bond market standpoint? So again, from a demand standpoint, this will help significantly. I think we use a lot of credit guarantees in other places, but I think this is one area where still there is a chance to push this conversation one more time, to have the DFIs, the SIDBs, the NABARDs, to take some position from a credit guarantee standpoint. So again, that I believe there is room. I think the whole anchor investment model, which is used, if you take Build in America, where the government takes, 5%, 10% anchor investment position for the first 12, 24 months, builds a lot of credit worthiness and reduces the cost. And I think therefore, again, from a demand standpoint, it's fantastic. I think if you look at supply side, enough has been spoken, but I do believe for the next round of NPS, can we create a 1%, 2% incremental cash flows? Because the multiplier effect of that is significant. And if you get good corporates, nicely governed corporates through the NPS route, I think there is a significant opportunity over there. And I think if you look at our insurance regulations right now, or the pension regulations right now, it's very bucket specific, AAA, AA. I think the world has moved to a more dynamic risk management where you could have multiple buckets and then you can do concentration risk, stress testing by tenor, by rating and stuff like that. So I think that could certainly help supply. So in my mind, some of these factors can really push the envelope a bit more. So from 20%, can we get it to 60, 70% number? I think that would be the endeavor on the bond side, if I may.
I'd just like to...
Yeah.
If I may take the liberty of asking you a follow-up question.
Yeah.
So see, corporate bond market is again high on our agenda.
Yeah.
So on the primary side, I think looks like we've done well. There's about 1 lakh crore raised every month.
Yeah.
That's the number suggests. But 98 or 99% is private placement.
Yeah.
So one question was why this lack of public market there? Two is what could we do to improve liquidity on the secondary market side? These two questions.
So I would say, Amarjeet Singh ji, first, can we at least do T0, T+0, T+1 sort of an approach on the private side, get them listed ASAP? Can we do some sort of a shelf documentation, approved tranches that, they can move a lot more quickly, lock in liquidity when the rate arises? So that helps significantly. Secondly, creating this whole primary dealer network for corporate bonds, giving them some sort of an incentives, where you can give them incentive in terms of liquidity or capital requirements and pressurize them to do two-way quotes. And thirdly, like the US has done TRACE, if we can create a market data infrastructure where across all tenors, across all maturities, if we can get a nice, curve, which is not to be discovered every time, but it is tradable, and at least the AAA and the AA issuances are pushed on that agenda, I think that will bring a lot more liquidity and discipline in terms of, integrated credit surveillance, if I may say, is a big thing abroad, and we can do a lot more in that area as well. So I would say these are some of the thoughts and ideas, in terms of help.
Absolutely right. So we are looking at some of these suggestions. So, one on the two-way quotes, it's like market making.
Yeah.
The issue is you need capital to support that.
Yeah.
So I think one interesting trend is that private equity is willing to support that. So that would be interesting to watch as we go along. But thanks. Yeah.
Revti, you wanted to add something.
The other point which I wanted to say is that, he's absolutely right. We see only AAs and AAAs actually going to the bond market. Whereas the PDs of A's in India is also very good. So we're not seeing, A-rated papers coming or picked up by investors. The other point is that, even if regulatory authorities like the PFRDA or IRDA have allowed insurance companies and pension funds to invest in A-rated paper with a EL1 rating, which is an expected loss 1 rating, there is no issuance which has been subscribed to. So some of these things, have to be probably pushed from a regulatory point of view also to all the market participants for them to pick up papers. Because on the credit curve, I think we've come a long way in terms of the stability of the PDs that are observed in the investment grade category in India.
And it's so true because, if you take US, 80% of the issuances are in A and BBB, whereas here 92% are in the AAA, and that too banks and NBFCs. So the corporates are still not as much as they should be.
Pratik bhai, The problem is that return of principal is more important than return on principal. यहाँ पे contract enforce करने में सारे बाल निकल जाते हैं.
No, I get it, but that's where you have to keep pushing, sir.
Now we have 12 minutes left, so 3 minutes each for participants. Anand Rathi ji, we have got 5 crore investors in mutual fund, about 12 crore demat account holders unique in equity market. But in most of those demat accounts, there's nothing much in terms of value. How do we really build retail investor cult?
I think first, let's look the positive side. India has really developed the retail market pretty well, pretty fast. And I must compliment mutual funds really playing a very, very active role in this. Obviously, brokers have gone, in every part, nook and corner of the country to bring investors in. I think we have two challenges. One is how do we get more investors into the market? Because still the amount of savings coming to the equity or capital market is still far less than 10% of the savings. The second, obviously, is whosoever is there, how do we make it more active? And particularly move from, SEBI has been working on that, move from speculation to the cash market. I think the first challenge, obviously, is far greater to bring more people in, where both broking community, along with exchanges and SEBI and mutual funds have to work together. I think this, B30 or B15 thing which was given, a differential commission is very important. One thing which I think is very important that the distributor must make adequate money to be able to do that. And therefore, I think there's a need to have more categories. Maybe we have B15, C15 or D15. I think have a differential, compensation given to distributors because the cost is high. Secondly, also for the small money coming in, wherever it is coming, if it's less than, let's say, 500, SIP of less than 500, there could be differential commission. I think ultimately the market is moved by distributors or the marketing agency. My industry experience has always shown if we didn't compensate our distributors enough, you can't get enough business. So I think one thing which we need to do to expand, make it little more liberal compensation policy to attract people in. The other products are there which are giving far more remuneration. So people move to more than equity to the other markets. On the second aspect of bringing more speculation into cash market, again, I think the entire tax practice or even the STT, etc., I think is today encouraging more speculation than cash market. The charges should be the other way around. The cash market should be even exempt from STT or maybe lower STT. So I think people have made money in cash market more, while SEBI is saying 92% people have lost this. How do we bring the change? So I think there has to be some way, some fiscal way to manage it. And one more area which, of course, I'll not call it retail, while we are getting FI's money, but the work on NRI's investment, I think we have not done enough. That's where I think the SEBI and everybody has to work on that. Now most Indians are very affluent overseas. And our little experience in Dubai, having wealth management, has been very rewarding. And I think that's one area where we bring more people. As we bring more liquidity to the market, there'll be, the cascading effect on bringing more people to this market.
More the merrier. Ganeshan, BNP has a very large and profitable green financing, sustainable financing business. What's the experience in India and how can BNP India be as good as BNP worldwide in sustainable financing?
Yeah. So this is, obviously a very relevant topic both for BNP Paribas and India. So if you really look at India, I think we have taken the most challenging transition target. So if you, really look at, even though we are 2070 as a country in terms of net zero, I think given where we start, I think that is quite an ambitious target, even if you look at some of the other countries, even the developed countries globally. And unlike a lot of countries which are now, on the borderline of saying, do we continue or do we change? I think we are fortunate that, the leadership is kind of has a clear vision, and we are continue to be on track on that. I think the second encouraging thing is a lot of the large corporates have their own net zero target. And, if you look at most of the large companies, listed companies, they are somewhere between 2035 to 2050. So I think in terms of, most of the large groups, we see them achieving net zero much ahead of the country's 2070 deadline. Now, this will need a large investment. So there is, obviously, the more avenues you can open up, it is better. Today, the funding is largely the bank and NBFC market, which is providing the funding for this sector. And yeah, I think as Mr. Amarjeet also mentioned, I think the amount of green bond issue today is a minuscule of the billions of dollars that we need to spend on this journey. And there is no real, if you look at the green companies listed, it's handful. So I think this has to change significantly. I think one is, of course, the policy, which I think the framework is there, but I think you need to reduce probably the friction cost, because if you look at the bond, I think the first question a lot of corporates ask is, will I get a discount if I do a green bond? I think today the answer is no, because there is no pricing benefit of doing it, but there are additional costs. So you can call it, so if you can reduce that friction, obviously it will change. Second is obviously the supply of capital, because we don't have enough funds which are targeting these investments. So if you look at Europe, which is obviously the hub of a lot of this green funds, a lot of funds have kind of mandates to do either the entire fund or X percentage of the fund towards these investment. And maybe that is something that you and the industry can also see whether that is attractive. And I think from our anecdotal evidence, we think there is a demand. Like we have a large global capability center in India, over 12,000 employees, and we're really, when you recruit at that young age, a lot of them place a high emphasis on the ESG focus. I mean, that's when we do a survey, I think they really value it. So I'm sure when they have to invest their money also, there will be a demand from the next generation to look at funds which can also align with their target. So I think a combination of the right policy, the right taxonomy, and the right kind of fund base will lead to a growth. But when that will happen is for us to see.
Revati, if we look at Indian 10-year yield, a decade back it was going at 6.5% above US. Today it's going at 2.5%. So effectively, we have done something better. And when we look globally, the credit markets are going through all the volatility. As you mentioned, some of the funds have shut down. What's the outlook on Indian credit? Where we should be careful, where you see some stress building up, or are we going to be in air without any turbulence?
There's never a flight which doesn't have turbulence. So, but you're absolutely right. If I look at, let's say globally, we are poised to, global GDP growth is poised to around 3%. It was 3.3% last year, CY 24, and pre-pandemic it was 3.7%. So we are definitely slowing down globally. So we call it an era of globalization. The second thing which is happening is that governmental debt is increasing globally. So if you look at all the governments of developed nations, while their debt to GDP is more than 100, but on the whole, for the world, if I take an average of debt to GDP, it will be more than 100 now, which is, similar to what we had in the pandemic levels. It went down and now it is coming up. So we're seeing a very uncertain global environment, and the global uncertainty index is at its highest today. In that backdrop, how do you see India? Now, India happens to be the only country where your debt to GDP ratio is going to actually come down in the next 5 years. So it's going to be a reverse situation than most of the other developed countries in the world. We saw India GDP growth rate of 7.8% in Q1. We saw quarter 2 results, and they were very encouraging. You saw 15% top line or bottom line growths, which are happening for top 500 companies. So from a credit side, we track a ratio, and we publish a ratio which is known as a credit ratio, which is a ratio of upgrades to downgrades. And we do it on a 6-monthly basis. If I look at this ratio in the last 6.5 years, this ratio has been on an uptick. The latest number which we got in September was 2.6, which means that there are 2.6 times more upgrades than downgrades. So if there are 100 downgrades, there are 260 upgrades in the half year. That in itself is a great number. This number has been coming up, So last year in H1 it was 1.6. Now this year it is 2.6. We did a survey of around 6,700 odd companies to look at what's happening to their debt EBITDA, what's happening to their interest covers and all. So the debt EBITDA ratio has actually come down in the last 10 years from 3 point something to 1.5 times. So we've seen a steady improvement in that ratio. The interest cover ratio has gone up from 4 times to 7 times. Again, we've seen a significant uptick in that ratio. So corporate India, the way it is and the position it is today, and has learned a lot also from the mistakes of the past, from going through IBCs, promoters losing control. So I think when we're seeing at the credit uptick today, that's also one of the woes, that private investment is not really picking up the way it should be. But having said that, whatever investment is picking up, corporates are conscious about the debt equity at which they are funding it. It's not no longer that 70-30, it's probably closer to 50-50 that they are funding this. Do we see stresses? Yes, export-oriented sector, we've still not patched up on the tariff front with the US. So we're still among the 50% highest tariff countries. And that's where, sectors which are heavily dependent on the US, like gems and jewelry, marine products, electricals to some extent, chemicals. Some of these, sectors are sectors to watch out for. But on the whole, on a credit environment side, we remain optimistic.
Thanks, Revati. Pratik bhai, in equity market, cash market volumes are low, derivative market volumes are touching sky. In debt market, cash volumes are high, derivatives virtually don't exist. Interest rate future have no futures. Why is this dichotomy, and how do we correct it?
I think I should be asking that question to you, given the amount of time you've spent and the number of regulators you meet. But I think goes back to more volumes, more issuances, goes back to availability of more data. I think clearing settlement still is not at par with equity, which is very clear. Margining is also very different still, unlike what we do in equity. So there is a room to take forward. I think also we are dealing with situation now. Obviously, Amarjeet Singh is not there, but how do you get RBI, SEBI, insurance regulator, PFRDA all together? If you really want to drive credit and bond market as an agenda, where you have a unified credit council to give, those guidelines. And lastly, I think, a big component of the market volume globally is also the asset-backed market. Now, we have obviously made inroads with InvIT and others, but proper, the Fannie Mae, Ginnie Mae's of the world, how do you create a replica of that? Because then through that, the derivative and the other pieces will emerge as the volumes sort of pick up there. That's my hypothesis, in terms of how this can help further.
Thank you all for a very enlightening discussion. Unfortunately, we have run out of time, so we can't take questions, but you had opportunity to ask questions to SEBI whole-time member. Thank you for your attendance. Thank you.
Thank you, Nilesh bhai.
Thank you so much to our esteemed panelists for that insightful and engaging session. Now, to mark our gratitude and appreciation, I'd like to request our moderator, Mr. Nilesh Shah, to kindly come forward and present the mementos in the mentioned order. Mr. Ganeshan Murugayan. Mr. Anand Rathi. Ms. Revati Kasture. Mr. Pratik Shah. I now request Ms. Revati Kasture to hand over the memento to Mr. Nilesh Shah.
We shall shortly be starting the next panel. ठीक है? We shall be starting the next panel. May I request everyone to take your seats, please? The panel is on funding India's long-term growth, matching supply and demand. And may I invite on stage the panelist of this session, Shri Manoj M. Ayappan, Joint Secretary, Department of Financial Services, Ministry of Finance, Shri Rajkiran Rai Ji, Managing Director, NAPFID, Mr. Palash Srivastava, MD, Additional Charge IIFCL, Sonia Das Gupta, MD and CEO, Investment Banking JM Financial, Mr. Saket Khetan, Senior Partner, Khetan Legal Associates, and we have Shri S. Ramanan, Chairman, Pension Fund Regulatory and Development Authority, joining online with us today. Thank you all for joining in today. I now request Saket to take the discussion forward. Thank you.
Thank you so much, and welcome everybody to this very important session, particularly given the stage where India is in its development and the core requirement for it to be a 5 trillion economy by 2047. Before we start, I just like to request Mr. Raman, who is joining us virtually, to address us, and then we can start the panel. So if you can give your views on the topic, and then we can get into the panel discussions.
Thank you, Saket, and a very good morning to all of you. I'm afraid I just couldn't make Bombay, but it's great to be here amongst all of you. It's excellent that CII has put together such a high-level conference on such an important and pivotal topic. So if we're looking at, may I use the phrase, for the country to pivot and actually move towards that 30 trillion target economy by 2047, which is the dream of Viksit Bharat. I think a lot of us on the panel and in the conference will have to make lot of movement. There is a policy, let's say, finesse that needs to come about. We have excellent policies already in front of us. It's about tweaking those policies a little bit to make it work more quickly. I think it is, time is of essence. There's a tremendous urgency to get, for example, the National Infrastructure Pipeline, which has been identified, but it now needs to roll out. We are really talking about the segmentation of funds, wherein we are looking for long-term capital, and that's really what was discussed in the earlier panel also. How do we get this? The numbers that I seem to have is somewhere in the region of about 50 to 60 lakh crores is the patient capital that already is identified in the economy. This is between the insurance funds, the pension funds, EPFO, and other such what we are calling as patient capital. I'm not including the debt funds with the mutual funds, because there is certainly a slight difference between the customer expectation which goes into those funds as compared to the money that is coming into insurance and pension funds. So the mutual funds have collected and accumulated vast sums of money. They've actually transformed the country in a way of going into every nook and cranny and picking up customer money. But that fund is really a 3 to 5 year play, is the sense I get. Of course, the banking system is very well known and it's done human service, but again, that money is 3 to 5 years. So if we're looking for that sub-segment, which is probably the desired fast-growing segment, we're looking at money at 15 to 20 years. And therefore, how do we get 15 to 20 year money to get into a project with the kind of sensitivities of risk being a little more elevated when we're talking about long-term paper. And that is really what I think we should be focusing on, because in the pension funds, we are seeing that money accumulate, but we find that we're unable to target that money into this area, this desirable area of infrastructure funding. So let me just give you a sense of where the pension money lies. We've got about a little more than 16 lakh crores, of which maybe 20% is equity. But all this money is long term. We have about 50% or 55% in government debt, and the remaining is 23-24% is corporate debt. The remaining, of course, is liquid. So we are looking for maybe a sort of corporate debt moving up from the levels of 22 to 23% to inch towards maybe the 29 and 30%. And that itself will realize a lot of money. I don't have this breakup for insurance, but it may be more or less similar. The equity part is something that is rising in most of these funds. In the EPF also, it is going up. And equity, therefore, forms another very substantive long-term play. Why is it that we're not putting our money into BBB rated corporate bonds? And that, I think, is a very central question. We probably taking a risk view which is a little more adverse than what maybe those projects deserve. And that is really where the tweaking needs to come in. We have the ability, so in fact the pension funds are being guided towards increasing their ability to do that risk identification and that ability to go into the project financing. We have certainly got the capability amongst all of us in this room, but somehow it's not translating into the regulators allowing for money to go into a triple rated corporate bond. So we, of course, have one eye on the subscribers' money. We wouldn't like to take a call where we widen the regulatory investment ambit and bring in BBB, because there is a fear, and that's probably been heightened by a few incidents in the last 5 to 6 years. But the scenario that we're sitting on is to be compared not with the last 5 to 6 years, but what it was 15 years ago. And I'm saying we are at an altogether jump ahead in terms of risk evaluation and identification as compared to 15 years ago. So what is it that we still need to do? And having spent many years with the concept of guarantee, I certainly feel that is the way forward, because it's already very well explored. It's well known to all of us that we have the ability to upsell the risk, whether it is to insurance companies or guarantee companies. We have in India itself the best example of a very large guarantee program coming into. Of course, this was a much shorter term risk. During COVID, we had something called the ECLGS scheme, which was rolled out for the MSMEs of this country. And I can tell you it was the reason why maybe 70% of the MSMEs were saved from even worse adverse consequence of COVID. So it was 100% government or a sovereign guarantee, which went up to about 3.6 lakh crores. And you'll all be very surprised that the maximum claims that have come against that guarantee of 3.6 lakh crores is not more than 18,000 crores. So it is a very successful program. Now, we need to bring those sort of, good examples into a very different field. We're talking about infra finance, but we really do need to look into that role of guarantee companies. And I'm saying we could even get the likes of FIGA to come in and get them to, and that's the World Bank guarantee arm, and we need to get them to look at how we can develop our credit market better. We already are in talks. In fact, Mr. Rajkiran Rai is here, and I'd be delighted to hear him speak about what they are proposing. And I think the partial credit enhancement scheme, which has been given as a responsibility to NABFID, is one of the instruments that we are looking forward keenly. But I think we also need to talk about the fact that rating agencies have a particular way of doing their work, and we are all, let me say, the prime customers of the rating agencies. And how do we therefore try and get a better nuanced look from the lens of the credit rating agency? Because, you know, that is really where that alphabet soup comes from. Whether it's, you know, an A or a triple B, it is really for the rating agencies to work on that. And I would be very happy for that, exercise to be a consensual exercise between us as the guardians of public funds and the rating agencies as some of the better known corporates. So I would, stop over there. I've just tried to outline the concerns which the large funds and the long dated or the long only funds, as we are known as, what are our concerns, and why is it that there has got to be a better marketplace that develops so that the savings get transformed into productive investments. Thank you so much.
Thank you, Mr. Raman, for that and your comments in regards to long-term financing being available and what is required from a regulatory perspective to deploy that. Mr. Ayyappan, if I can ask you to address and your points, and then we can get into discussions.
Yeah, thank you. So, honorable dignitaries, distinguished guests, colleagues from the government and industry, ladies, gentlemen, good afternoon to all of you. So, when Chairman PFRDA sir mentioned about the availability of capital now, I can tell you a few steps which the government has taken in the past or in the recent past also, like National Monetization Program, National Infrastructure Pipeline, setting up of institutions, large DFIs like NABFID. These are all some of the steps which the government has already taken in the past. Also, if we look at the current state of economy, I mean, we would be in the most benign or the best state of economy today. While we think about Viksit Bharat, I think this is the best platform which we can get. Very low inflation today. The inflation, I mean, we should think that whether we should have a little more inflation. We have very good forex reserves, good balance sheet for the banks, of the corporates. So overall, if you look at it, the economy by itself is giving a very, very good picture. So this is a good platform which we can move forward. But when we look at Viksit Bharat, which is 2047, there should be some step which we have an intermediary step also. What we look at the next decade. So are we looking at a 10 trillion economy as a first point to reach? So within next 7 to 10 years, if we want to reach that, what's the kind of investment which we will require? That looks to be around, in terms of infrastructure requirement, anywhere around 1.6 to 1.8 trillion dollars. So where is this huge amount of capital going to come from? Of course, the balance sheets are very strong. So some of the private capital which is now lying in the balance sheets should actually be getting deployed as the country progresses. Apart from that, while we look at the heavy lifting which was done by probably the banks and to a certain extent the government, this will have to now spread to other forms of capital. Like Chairman PFRDA said, there is a good patient capital waiting in the form of insurance pension funds, which have to get deployed. Government has brought in various measures, for example, the partial credit guarantee partial credit enhancement scheme which has been allowed. Also, investment norms for insurance and pension companies are getting modified. So, but at the same time, it is also for the developers or the corporates to develop infrastructure projects which has good resilience. You get risks managed. I think we are in that stage of the development where the risk management is becoming the most critical component. How interrelated risk can be managed, how ensure the cash flows which are estimated are flowing, how the risk of default can be managed. So all these things, if we are able to get a good point, get to a good point, I think we are going to see a good finance availability in the system. Apart from that, multilateral fundings are available, blended finance can be taken, green funds are available. So once we look at each and every subsector within infrastructure, I think if we are able to get the project piece correctly, today we have enough capital which is available. Also, while we talk about infrastructure as a major development, we should also look at another two major pillars which we may have to have from a long-term investment perspective. One is the MSME, where the MSME sector requires a lot of capital in the form of working capital as well as the fixed assets creation. Second is the rural economy. While we may not look at it from a long-term financing perspective, but the kind of cash flows and the kind of investments and the funding that is required in that economy also is very, very large. So while balancing a large investments into infrastructure, balancing that with rural and MSME will be the key for the Viksit Bharat 2047. This is my initial thought.
Thanks so much, Mr. Ayyappan. Being a lawyer, I've heard my banker friends tell me take the lawyers out of the room and the risk will be balanced. But having said that, there are two sides to the equation, right? The first side to the equation is effectively where is the demand coming from? Mr. Rajkiran, if I can come to you, which sectors, according to you, need the most attention and long-term investment in infrastructure? Is it infrastructure, real estate, logistics? If we can identify what requires the capital, we can then look at what sort of capital is required.
Yeah, and thank you. I think the chairman, PFRDA, Mr. Manoj Ayyappan sir, they have put the right perspectives for today's discussion. Outlining what is available and what are the processes needed to ensure that patient capital which is there, it finds way to the infrastructure sector and other big project financing what we need. First of all, let us assess what is the kind of money we are looking at is needed to reach that Viksit Bharat target. That is the 30 trillion economy by 2047. The World Bank report assesses this money requirement on project financing and infra something between 770 lakh crores to 850 lakh crores is the requirement for 2047. So we need to spend double than what we are spending today to reach there actually. 30 trillion economy needs that kind of investment to come in. So we need to double our investments. And today, most of this investment, the heavy lifting is being done by the government. They spend about 3% of the GDP on infra because if you look at the road sector, more than 80% of the spend happens from the government budget and other sources. Only the energy sector, it is more private rather than the government. But like sectoral issues, we'll look later. But then, now actually, since your question is which are the sectors which are likely to absorb credit and which need credit. So again, going back to this report, because Niti Aayog also has these assessments. So more than 300 lakh crores out of these is needed for urban infra. Actually, going forward, the biggest consumer of capital is going to be urban infra. Because we see this every day, because urbanization and the need of the urban infra. We have not got the structures right to absorb this kind of credit. There's another, question and which we have to deal with separately. I will not touch that. But since the sectors which need credit is, the biggest is urban infra. Then the second is energy. Like, the kind of energy consumption. We talk of data centers. Now, when we talk of data centers, they are guzzlers of energy. So, the energy requirement is going to go up substantially in the years to come as more and more data centers are shifting to India and, they are seeing that investments happening. So then the logistics sector, the multimodal logistics, actually we have looked at sectors standalone basis. Somebody does road, somebody does railway, somebody is warehousing, somebody is port. Now we are looking at holistically the multimodal logistics park and all that, which is essential actually. So the port-led infra and the multimodal logistics are the biggest areas, again, consumers of the capital in the years to come. So these are the focus areas where there are other sectors actually where healthcare, education, everything needs credit. But these are the 3-4 sectors according to us which are going to, take the huge amount of credit in years to come. To realize that 30 trillion target, actually we need to create, while logistics sector, particularly if you look at road and all that, the structures are created right, it is doing very well. Energy also, yes, we are seeing cancellations and all that, which is happening. But then I think mostly the structures are right and it is attracting a lot of investment as of now. We need to fine tune certain things, which government is well aware. And I hope in the next 2 years, those things will get credit. Urban infra, we are yet to create a structure to absorb that kind of credit. Multimodal logistics, a lot of policy and other things are in place, but then there is a long way to go. If you have to bring down your logistics cost substantially, you have to get it right. Huge investments are needed there. Thank you. I'll stop here.
Thank you so much, Mr. Rajkiran. So interestingly, when I was looking at capital markets in a panel like this 10 years ago, people said that capital markets didn't have the depth. Now we have, pensions, insurance, mutual funds, by way of SIPs, pushing money into the capital markets where, according to Google, 71 billion has gone out of, foreign investment has gone out year to date from Indian capital markets and it's sustained. So it's reached some sort of a maturity and depth. So we're looking to do the same as far as long-term financing is concerned and the bond markets is concerned. So before I go into this, if I can come to Palash, outlined sectors, right? Energy, urban infrastructure, and 3PL, effectively logistics, right? Two of them are sort of short